Hi there, Livewire readers and viewers. It's James Marley here, and I'm joined by special guest Ben Clark from TMS Capital. Many of you will be familiar with Ben. He's a regular on Livewire's Buy, Hold, Sell. He was on the Rules of Investing podcast at the end of last year. But he is a financial advisor, a wealth manager, and I've brought him in today because I think he brings a unique perspective to running portfolios. He deals with a lot of clients that are just like you guys out there in the Livewire readership. And with the volatility and all of the big news items hitting the market at the moment, I thought it'd be a great opportunity to get his perspective, talk through some of the good stuff that's happening, talk through some of the things that haven't been going so well, and get a few of his tips. So Ben, great to have you in. Thanks for coming along.
Thanks for having me, Jimmy.
What do you think are the most important changes that are taking place in the market today, and in particular the ones that are weighing down equity markets? Because there's a raft of things that are hitting the headlines at the moment.
Yeah, I mean, December, when the markets were hitting all-time highs it was almost the last trading day of the year. Feels like a distant memory, doesn't it? But look, there's one issue that was last year's issue, which has continued on, which is inflation. And we all know, particularly in the US, where I think there was a feeling that would start to have topped out this year and maybe we were through the worst of it. Clearly, that's continued on, and the Fed, with time, has got more concerned about the persistence of it and the strength of it. And you know, I think we are seeing some early signs of a sort of a wage price spiral in the US, not so much here. But on top of that, and this is the funny thing, there's three real issues at the moment, but they're all completely interlinked, which is quite unusual. You've got COVID. Now, of course, that awoke the sleeping beast in inflation, and the Omicron strain that ripped through the world in December and into January is probably one of the things I think that have really seen the Fed change their stance. But it's China now. You know, China has locked down 50 million people in the last 2 days. And we've seen what's happened in Hong Kong, and now the question is, how long does China pursue what I think most people would say is a fruitless exercise of trying to get zero COVID, and how much pain are they willing to take for the economy and for people for that? And then you've got Russia, and you know that's the other big recent issue. I think markets didn't see the invasion coming. They didn't see the fight back that the Ukrainians have put on and the united front that the West has faced the invasion with. And all of these issues, James, are effectively asking the question of does this heighten the inflation issues that we saw last year? Russia produces a lot of soft and raw commodities, and that spikes prices. And then China, you know, like they've just announced that the largest port in China has been shut down, Shenzhen has been locked down. So this is going to create further supply chain issues, and it's going to be how does the world deal with that, and what implications does that have for bond yields, which is flowing into equity markets?
It's interesting, transitory seemed to be the word of 2021, but I haven't heard it so much in 2022.
I think when you go back to it, was when Jerome Powell, I think it was like December 27 or something, he got up and he said transitory is just that. It's in hindsight, it was transitory, the phrase itself and the view of that phrase. And that's really when bond markets kicked off again. And that's what's led to the volatility that we're seeing in the share market. And I think, you know, with these issues, none of us have been through a global pandemic. We don't know how the tail of this works itself out. We don't know how long the war in the Ukraine drags on for, how intense it gets. We don't know how long China persists. So the market's trying to price something in at the moment, which I think is virtually impossible to know the answers to, and that's why you're seeing these big swings day to day.
I think that's a good point to take me into the next question, and it really is, around the big swings that we're seeing in sectors. The tech sector is one of the worst performers year to date.
Yep.
At the other end of the scale, you've got oil. Not far behind, you've got the material sectors that have done really well, and people are looking to shift and move around.
Yeah.
Of those things you've touched on, which ones are significant enough to have a bearing on the portfolios that you manage, and what are some of the changes that might flow on from those considerations, given that things like war and the pandemic you have no control over?
Completely. And look, I think the thing that's probably changed in my thinking is the inflation line. It clearly is going to persist for longer. I saw a good stat yesterday actually. In 2019, I think about 38 million people entered America with an intention to look for work. Last year it was like 2. So that's not going to go back to 38 in 2022. It's going to take time, and I suspect that inflation is going to take longer than I thought it was to top out and to pass through. And I think when you look at what you're investing in, certainly a slight tack that we've taken, not to say we've made big wholesale changes on the back of any of this, is that we've probably sort of shifted toward the more mature businesses, growth businesses on the market or in the portfolio, slightly at the expense of the longer duration growth businesses. And that just feels, for the moment, with all this uncertainty that's occurring, to be a bit of an insurance policy against the things that we don't know how they're going to play out. So businesses that might be growing at 15-20% pretty sustainably and are trading on 35 times earnings maybe, as opposed to the hyperscale growth businesses which are on much higher PEs. It's probably just morphing that way a bit. Also, for private clients, it's been making sure that we maintain, like this, we sort of call them the ballast stocks, the things that smooth out the volatility that we're going through at the moment. So we've had 2 of those got taken over, Spark and Sydney, and we've been looking for replacements for those, but making sure that we stick to that philosophy. The temptation is to think, oh, well, this is in a really oversold area, so we'll move that money into there, but you want to stick to what you're doing in your approach.
Now, I know you're a stock picker and not a macro economist or forecaster, but I am interested just to get a temperature check on how worried you are that central banks might be behind the curve and that we're going to get a really aggressive rate hiking cycle. And how are you viewing the difference between what's happening in the US and Australia?
Okay. I'm not worried, but I think the Fed definitely have been caught behind the curve. In hindsight, and hindsight's a beautiful thing, they probably should have bought a bit of protection against the uncertainty that was out there. Jerome Powell was the first to say, we don't know how the end of this pandemic plays out. But in hindsight, they probably should have lifted rates a few times last year and signalled to the markets this isn't a rate rising cycle. This is just a bit of a normalisation, and then we look at the data and see what goes from there. But always be wary of people that tell you what they think the Fed should be doing or the RBA. All that matters is what they are going to do, and they're about to start the hiking cycle. It will be an aggressive hiking cycle, but you've got to remember the bond market has already priced that in. So the markets are not going to wake up in December and think, oh wow, they rose 7-8 times, they raised 7-8 times this year. The market's already expecting that. So where you could get further volatility from here is if the market believes that that is still too conservative and that the Fed's going to have to go even more aggressive than that aggressive stance. And I think that's really going to be determined by the things we were speaking about at the start of the interview, which you just got to see how these things play out. But honestly, Jimmy, if you take a step back, for all the talk of high bond yields, rising bond yields, it's not so much where bond yields are priced at now, it's the speed at which that pricing has changed. That's what's unsettled the markets. It's normally a repricing might take 6 to 12 months of this kind of magnitude, and it's probably taken 2 or 3. And that's been a pretty violent move in the bond market, and that's seen the volatility created in the share market. It's
interesting because you can kind of rationalise that quite easily. I remember being in Sydney in December 2021, and it was just as everyone was coming out of hibernation and starting to get out and about. I was in the rocks and it was heaving.
Yeah.
And the next thing you know, we were all in lockdown. My family had COVID and all that sort of stuff. So you can see how that view changed quite quickly and probably rationalise it pretty easily. Now, Benny, when I was driving, getting ready for this interview, I was listening to a podcast you did with Patrick Polk towards the end of last year, and
different time.
It was a different time, and you were talking about growth stocks and what it takes to invest in growth stocks and how to hold the distance. If anything, it's more topical now because I think a lot of people are having their conviction tested. I'm keen to know how has your conviction been tested, and those of investors out there in the growth part of the market, and are you being forced to be sort of, is your hand being shaken loose a little?
Investing well is as much about managing your emotions and taking a step back and trying to look at it from an arm's length sort of point of view. So it's actually, when you hear a quote like that, it's a good reminder that that periods like this will occur. when you're in the depths of those periods and it feels like everything's, sort of hitting you in the face and things are against you, it's easy to lose your stance, lose your mentality, lose faith in what you believe in. But this is really a time I think you've just got to continue to remind yourself of, what you're trying to achieve. Yes, you've got to keep going back and checking that the businesses that you own, because, everyone says growth businesses, but there's a whole, there's unprofitable growth businesses that won't be profitable for years. The revenue growth might be exploding, but to me, that's become an area of the market I would increasingly not go near at the moment. I think that has changed. But growth businesses are doing what they do. If you look at sort of Afterpay as probably one of the big examples, it used to have a 30 to 40% pullback 2 or 3 times a year from the moment it listed on the ASX. And it would constantly test your mettle. So I think you've got to keep making sure that what you own is what you want to own. And the good thing is we've just been through February and we've heard most of these companies report, so we know how they're travelling. So that is one thing that you've got in your favour at the moment. It's not like we've had no news for 3 or 4 months, and maybe the market's telling you something that you're not sort of, that might make you a little bit more wary. But for the moment, I think, hopefully it's good advice. And the other thing is, you don't want all of your portfolio in growth stocks. Like that's an area for people, and having that safe ballast stocks that hopefully irons out some of this volatility that we're getting at the moment.
We alluded to it there. We had reporting season, but before I get you to crow about a couple of cracking results, let's do a mea culpa and talk through some of the ones that fell short of your expectations and things that you thought would do better than they did. Yeah.
I'd start by saying I thought the results season was remarkably good. Earnings are growing at sort of twice historical trends, and even though a lot of businesses are facing a lot of cost issues across their things, but for us it was actually 2 serial offenders. Appen and Tyro were the 2 businesses that both disappointed, and Appen, has been one where the result itself, I think it was a very narrow miss versus what they guided, but still it was a miss, and it does highlight a vulnerability of that business, which is a lack of earnings visibility. The thing that more unnerved the market, I think, is they said that we're going to stop giving year-on-year guidance, and I think it's actually the right approach. It was probably the wrong time to employ the approach. Everyone was pretty sketchy at that time as it was. So you saw, a much bigger share price drawdown than I think you would have. They gave 5-year numbers, and this is the confusing thing, which just looked too good to be true. They're so far above every analyst's expectation of where they'll be in 5 years. We're sticking with it. It's a business that we skimmed some time ago, a few years ago, and that we've added to in more recent years. It's a fairly small holding, but I still think that there's a good business there. Tyro was harder, and that's really because when you look back at their last 6 months, for 3 months, most of their merchants were in lockdown. And I think the area that the market, I think, was disappointed on was that they're not seeing the operating leverage come through the business. So the margins weren't as strong as the market thought. But there's just, I'm more willing to give them the benefit of the doubt, because, they did things like they waived all of the terminal hire fees to merchants that weren't allowed to open. There is a bit of confusion around this Bendigo joint venture partnership and, sort of what impact that's having on margins. But I'm hoping that going through into this half, and you walk past restaurants and cafes and bars, they're very busy again. Hopefully we start to see the operating leverage come through the business. Those one-off costs that we saw, they hired 58 people, I think, in the last 6 months to spend $10 million on an office fit out. That had some impacts. The other thing I'd just say with Tyro is potentially it's a really good inflation hedge, because, if Cafe A is selling a coffee for $4 and that goes to $4.40, they take a percentage clip of that. So potentially this is a business like with Visa and MasterCard in the US that could do really well in an inflationary environment, because they take a clip of the nominal dollar purchase, not sort of the profit that the merchant's making.
So 2 sinners, both still in the portfolio.
Yep.
So the conviction stays strong.
Conviction is tested, particularly I'd say with Appen. Haven't added to them. because I do think that you want to probably build positions as my view is being affirmed by the numbers. And at the moment, my view is being tested by the numbers. And I think also like position size is important. You know, you don't want to go too hard at things where the market's telling you you're wrong, and that's what's happening at the moment.
Okay. One of the interesting comments you made the other day when we were sort of having a chat ahead of this interview is you talked about the fact that switching cost from lower quality into higher quality businesses is low right now because it's been a bit of a damp market. What are some of the examples of the opportunities that you are seeing present themselves amongst this selling, and maybe explain that concept to people?
Yeah, well, so what switching opportunities, let's start with that. At the moment, I'm sure that everyone that is watching this has got one or two stocks that they look at in their portfolio and think, why the hell did I buy that? You know, and it maybe was a tip on a golf course, whatever. One thing I would say is at the moment, it is really important that you have a business in your portfolio that is either profitable or it's on the cusp of becoming profitable. The concept stocks, the stocks that were trading on sales multiples, revenue multiples, subscriber multiples, to me, that is done in a rapidly changing interest rate environment. You've got to, I think to me, you've got to accept that. The good thing is that you can still move across into businesses that meet that first criteria that are heavily off, you know, where they were trading at on the 1st of January. There might be some cost in doing that, but what I would say is don't hold on to things thinking, oh, they'll come back. Some things won't come back. There was a lot of froth and excess, particularly in the second half of 2021, which is being really washed out of the market at the moment. And you know, some businesses will go to God during this period, and others, this is a period where the metal's being tested, but I'm confident they'll bounce back. To me, you know, I look to reporting season, and I look at potentially the more mature growth stocks that I was talking about earlier feel like a place to be while we're sort of assessing inflation and these things. So companies like REA, you know, grew its earnings 37% last half. It's every newspaper I pick up on Monday, record number of auctions on Saturday. That's great for REA. Seek, you know, the job market is as tight as I've ever seen it. Every headhunter that you speak to says Seek's, you know, change this pricing dynamic model. We're paying them more than we ever have, and we just got to do it. ResMed, you know, which has still got the tailwind of the competitors' recall. Macquarie had its best quarter on record. These are still 20-30% off their January 1, you know, 2-month prices. The businesses are continuing to trade extremely well. I suspect the opportunities at the moment, if you take a longer term view, are in those long duration growth stocks. You know, so, you know, we've been looking at Medicus, very high PE, feels like the thing you shouldn't be buying at the moment, but I suspect that's the time you want to be getting really interested. IDP is another one, which I listened to the result and I thought was, you know, excellent. They've got a big tailwind as the world reopens, colleges try to get people back. And Xero, which is one that we own and has been one of our largest holdings. It didn't report in the reporting season. You know, it's such a resilient, consistent business. I don't think you're going to get any bad news from it. It's dropped 40% from its January 1 high. So don't put the blinkers on and think, oh, I've just got to hold tight. You still do have to think, is this a business that's going to come back when the market comes back? The market will come back when growth starts to run. The businesses that reported really strongly in February and it was just completely ignored, they will be the first businesses to roar back.
I've got one more question here, but before we get to my question, just thought, given you've got so many clients that would be a lot like the Livewire viewers and readers out there, what are the best questions that they're asking you at the moment, and what are you telling them? Pick one or two of the best questions that you've answered.
When will this end? I don't know. No, I think you know, probably the best questions are, should I be worrying? That's probably the number one question. And when I say to clients, you know, I'm not worrying, hopefully that gives them some peace of mind, because you've got to remember, for a year and a half, the markets were almost lobotomized. There was so much money that was pumped into them to get us through COVID, you know, either into the economy or into the markets. for a year and a half, we didn't have barely had a 3% correction. You know, it was so unvolatile, despite everyone saying it's going to be volatile, you know, and to me, the longer the periods you get of that, you get excess building up, you get froth building up, and inevitably when you do get the correction that you need, which is why you want regular nice corrections in a rising market. Sounds counterintuitive, but they're actually healthy. They're just regularly taking the froth out. Otherwise, when you get the one, it can turn into a bigger one. So I think, you know, clients can ask things like, you know, they can get set on Russia, China, you know, these big macro things. But to me, you know, this is just a healthy part of markets, and there will always be a reason that you look back and say that was the catalyst for it. But it's probably more likely that the markets just needed a good flushing out. And, you know, a reminder I sort of try and give people is we own quality businesses which are continuing to grow despite all of the worries that we have out there in the world. And it's just inevitable to me that the market will come back to them and the rise will continue. It's just, I just don't know how long it's going to be. And that will be based on how all of these things play out. But so, you know, I think if you feel like you own the right businesses, and everyone I think in the back of their minds looks at their portfolio and thinks that they're quality businesses and they're a bit more debatable. If you've got quality, if you're stuck to your knitting, if you're trying to achieve your goals and objectives, make sure your asset allocation's where it should be, you're not losing sleep. Be patient. Just try and look away. Don't stare at a screen every day. Try and, you know, sort of take your attention off it. It will come back.
Well, Ben, my final question was going to be around some practical tips, but I think you've just done that. Okay. So I'm going to wrap up that interview there and say thanks very much for coming in today. Great to see you, and good to see a smile on your face.
Thanks, Jimmy. I hope it's helped.
Well, ladies and gentlemen, I hope you enjoyed that interview as much as I did. Remember to hit subscribe on the Livewire YouTube channel. We've got lots of videos coming fresh to you every week.